question, were you able to get my email after last class about the Vimeo link to the recording of the previous class?
I received it, but yeah, I have the link. I
Okay,
haven't
perfect.
checked it.
Okay, so if you can, if you can get a chance to check the link and whatnot, please let me know. I was able to access it, so um, I didn't have an issue on my end. However, as a user, you may have some issues. So again, I just want to know if there's any issues with this from your perspective. Let me know right away so I can solve these problems so that there's no any delays and whatnot. Okay,
Actually, I just tried and it's working perfect.
it's working perfect. All
Yeah,
right, all right, perfect. So that's great. So you always have access to these videos, Luke. Oh, Eric just joined us. Thank you, Eric, for joining us. Anyways, you'll always have access to these videos. You can always review them at your own discretion. And as always, I will always be here to provide you with additional help and whatnot. Okay? Perfect, Eric. Thank you for letting us know. Anyways, so Khaled and Eric, were you guys able to do your homework from last class? Um, either way, I did not receive your homework, so for that sake, I did not put them in today's modules. Luke, however, did do your homework, and I really appreciate that, Luke. Again, guys, your homework is supposed to be something that you are supposed to practice upon, and it's for me to give you additional feedback so that you can learn more from it. So if you don't do it, you're just really hurting yourself. But either way, Eric, because you've sent me your homework prior to today's
You are
class,
now muted. You are now unmuted.
because you were able to send me these slides before today's class, I've been able to incorporate them into today's modules. And so we can take a look at these and go over some of this before we actually start class. So, um, Luke, very good job on this particular stock right here. This is Apple. Um, Again, if you guys don't know by now, this is what we refer to as a what?
trend.
A trend, yes. A trend is defined by a series of higher lows, right? So you have these points here. You can even argue this point here is higher than this point here, and higher than this point here, right? So that's why you have a series of steps leading up, and that leads to your uptrend, right? And in the uptrend, you have that established by the highs up here, and then that highs up here sets a resistance price level, right? Interesting enough, you chose Apple, Luke. Did you guys hear the news on
Yeah.
Apple today?
Oh no, what happened?
So just for reference sake, today is August 2nd, 2018. Apple today hit a all-time high of $207, making it the first company ever in recorded history to hit a market capitalization of $1 trillion. So I'll give you a minute to let that sink in. Apple is the first ever traded company to hit a market capitalization of $1 trillion, right? Just to give you a sense of scale on that, there is about maybe 70 or so economies in the world that do not produce more than $1 trillion in annual GDP production.
Yeah.
Right, so that's just something, some food for thought there, right? And Apple will be a big topic of discussion today because today we're going to be talking a lot about news trading, macro fundamentals, micro fundamentals, and whatnot. So we can discuss more of all the fundamental themes that has brought Apple to this point. So over here, um, you did draw some lines here. So Luke, can you explain and give me your thought process on this because I see a lot of information on here. So I'm gonna hand
Okay.
you over the presenter status, and you can draw on the charts and just explain your thought process as you're drawing through this or as you're annotating this chart.
Sure. So the first thing I noticed was this big um, this line going down, and I put a point at the top there and down here.
Okay,
Then for the bottoms, I did this and this, and it looked like it's is it called a wedge,
a wedge.
a bear wedge.
Yeah, yeah. Okay.
And, and after that, when it reached kind of the bottom there, it seemed like it just popped and started going up again.
Yeah, it popped in and broke out. Yeah,
Um, and then I saw this
in that
sideways
trend.
market where the yeah
Okay.
just hitting top and bottom in there.
Okay. So yeah, so
So
that
down
ranging part, yep. That one I like. That one's very clear.
kind of what I want to show there.
Hmm. Okay. Anything else you
I
want
have for
to?
you, man.
I'm sorry, can you repeat that?
That's all I have for you right now.
Okay. So I just want to give you my feedback on this. So I'll take back the presenter status. I'll give you my feedback on this. This here is very clear. So this area here from this point moving forward here, that's a very strong resistance point. So I really like that one, and that will definitely be a focal point of contention for price action, as well as the bottom one here, right? This one's really good. So you see a lot of like sideways ranging action here, and that one's really strong. So I really like that. This one, yes. So prior to, let's say for example's sake, let's say we don't see anything here in this square box, right? Let's say forget it, the market is trading before that box and we don't see anything. I would agree with you that this downtrend here or this downward slope, sorry, 1 second there, this downward slope here acts as a very strong resistance point, right? And again, once that breaks, it's not common sorry, it's not uncommon to see a break like this leading to lots and lots of volatility trading when it breaks up like that, right? Because when you have the trend line breaking, that is when you're more likely to see large moves in that, and we can see that here by the buying action that's taking place after that trend was broken. Okay. However, this here I find is a bit questionable, right? Um, I would say if you were to draw a downward trend line, I would say this point here is strong, leading to this point, but I wouldn't necessarily connect this point to this point here
Mhm.
because you don't necessarily see any strong signs of a reversal in the markets, right? I mean, like, why didn't we use this point to connect to this point or this point to connect to this point? You see my point? You see what I'm going at?
Right, right.
Right. So that's why I
Yeah, actually,
yeah, go ahead.
um, can I take over real quick?
Yeah, sure. Go ahead.
Actually, what I did is I did connect this to here because I did see this these 2 points, but
Okay.
I don't know how to make the line shorter. So whenever I draw something, it goes forever in the back.
Okay, okay, okay. Okay, I understand. I understand. I'm gonna dig back into the charts on the Haywood platform and I'm gonna find that out for you, Luke. But
Okay.
yes, if you have that yellow line there, then that becomes two
Yeah,
valid points where yes, you are beginning to see a consolidation in price action, and that's
correct.
all a wedging pattern is, right? It's a consolidation in price action. I mean, like even if we take a look up here, right? So take a look prior to that actual wedge. We can even say that this here began to wedge, right? And when you
Yeah, yeah.
start to see this, it becomes very obvious that you're starting to see volatility consolidating into one focal point, right? And that focal point
Mm.
typically leads to a large breakout or a large move in one direction, right? And so that's what we're seeing here, right? And we see that to the upside again when the market consolidates to this wedging pattern that you had here, right? So these are key points, especially when you were trading intraday, Luke and everybody else. When we're trading intraday, it's very it's very good to look for setups like this and anticipate the large move. The reason being is because these large moves will lead to explosive breakouts that will give us, more than a 3-to-1 risk reward, right? And these are the trades that will, that will essentially make up for a lot of the, bad trades that we do when we take during the day. Okay? So very, very nice chart here. I really like that. Here again, on this one, I see a lot of information going on. Luke, I'm gonna pass it back on over to you. And so, can you explain your thought process again on this?
Sure. I'm pretty sure I saw, like in the circles here, like head and shoulders
Okay,
dancing.
okay. Yeah, yeah.
Mm. So I hope you see it too.
Um, if you can,
There's a
if you can, you can draw
lower
directly on the
shoulder.
charts.
Here I have the first left shoulder, maybe the head,
Uh-huh.
then the right shoulder that is higher than the left one.
Yeah,
Then I drew the neck right here.
yeah. Okay.
And
Yeah, and then
that's
then
what I saw here. And same here, I saw like maybe a left shoulder, a
yeah.
head, and the right shoulder again.
Okay.
Maybe I'm crazy, but I saw that.
Okay.
Um, then what did I do? Why do I have these two lines? I can't remember now. Um, oh, right. No, this big line is because I was doing the neck. And again, it went forever because I don't know how to make it shorter. Same with this one.
Okay. Okay. Fair enough.
This
Fair
one.
enough. Fair enough. Okay, so
Um, then this.
okay, so I'm gonna take over here and give you my input on this. So for the first head and shoulder, yes, you're correct. You know, you have your shoulder here, the pullback in prices, right? And as we mentioned, head and shoulders can be sideways, right? And then
Yeah.
that breakout of the neckline, which actually happens over here, right? It actually happens over here, and that's the breakout in the neckline, leading to a move to the downside, right? And then we had our neckline here, right? And then the market broke out. Okay, but the second head and shoulder, I didn't really see a breakout in this one. So usually when the market breaks, it has to break out and it breaks out right around the neckline, right? And that neckline can be, it can be horizontal or it could have like a little bit of an angle to it. But this one, there was
Mm.
really no solid breakout, right? And so this one we can classify it as a false breakout.
Okay.
Okay. So keep in mind that and I hope you take this point away from the previous chart as well, is that a lot of technicals is really open for interpretation, right? Remember when I said that
Yeah.
technical patterns and whatnot comes down to a fine art and science,
Yeah.
right? So this is where the artistic interpretation may come in because let's say for example, especially on that first breakout here, You may have seen a head and shoulder, all right, but I was looking at this as a little wedging
Ooh, that's
pattern,
even better.
right? Right?
Yeah,
So you get my point about the artistic interpretation,
yeah.
right? Please take note of that. Is that like you want to see patterns that are easily recognizable, right? But you also want to make sure that when you're not kind of like curve fitting your own biases onto the charts.
Okay.
Okay. Okay, so again here, let you take this over and please explain your thought process as you were annotating this chart. And I do see the point about the lines being extended, so so I'm just gonna disregard that.
Okay. Again, I saw a head and shoulder formation here.
Okay.
Left,
Yeah, you can draw
ahead.
directly on the charts, Luke, by going to the right of the charts. Hover the mouse over the right of the charts, and a toolbar should appear.
Oh, okay. There you go. Oh no, that's not good.
Yeah, you can change the color and the thickness of it as well.
So, good thickness. Sorry, I'll get there.
It's okay, don't worry.
There. Oh, maybe too thick now. But shoulder, head, shoulder,
Yeah, and then that's a breakout, and then your neckline.
and then
Perfect.
right there,
Yeah,
breakout down.
yeah, exactly. Okay.
Then um, line right here.
Yeah, yeah, that's perfect. You nice little resistance trend line. Yeah, right. And you almost kind of see like
Looks like a
the megaphone pattern where volatility is
yeah, the
increasing.
megaphone. And
Yeah,
then right here it breaks.
yeah, there's a little
Um,
break of that trend line.
and then I saw a little bit of a head and shoulder right here again,
Right.
and it breaking up this
Yeah.
way.
Yeah, absolutely.
There you
Yeah.
go. That's what I have.
Okay. Is there anything else you wanna say?
No, that's it.
No? Okay. So, yeah, I mean, um, very good job here on this one. I mean, like you're able to identify the first head and shoulder pattern, the breakout, and then that led to a trend. I would caution here with this little head and shoulder again for the same purpose that we don't want to be curve fitting our own perception of how we see the markets because a head and shoulder, right? Typically signals a break to the downside, right? And so if this was a real head and shoulder, it would have broken to the downside. However, it didn't. It reversed. So it was a fake reversal head and shoulder, and it broke to the upside.
Mhm.
Okay.
So yeah, I guess it was too small of a head and shoulder.
Yeah, and a lot of times, head and shoulders, they present themselves very nicely on large time frames.
Okay.
Okay. All right. So what about here? What do you see here? Again, I'm going to pass that over to you.
There's a support, so a support line around, more like a zone actually,
Yeah.
right here,
So it's like a range.
and resistance. Yeah, and resistance here with
Mm-hmm.
a little bit of overshoot and undershoot.
Yep.
Um, and here is like a wedge formation, and
Okay. Yeah.
right
Yeah.
around there.
Yeah.
That's what I saw on this one. That's
Yeah.
it.
Yeah, perfect. Okay, so again, you know, always trading technicals with a bit of caution, right? And this is why it's very important we have to manage our risk properly. Is because yeah, I agree with you. This is a wedge pattern right here, right? And so you can say that, these are a little bit of overshoots in the market. However, this point here, and especially this point here, failing to reach the previous highs of back there, right? That becomes, a little bit like, oh, is this wedge pattern really going to play out, right? Secondly, that also creates two downward sloping points here, right? And again, this usually signals consolidation in prices, right? And on a bull wedge pattern like this, they typically break to the upside. But in this case, it broke down and went down here to test this support zone again. Right? So that's
Okay.
yeah. So be cautious with that, right? And then all your points here, these are all very strong resistance lines, as well as support lines as well. Right, so I think you're able to identify this very well, right? And the key here, especially next class, is when we start talking about this, is that when you're looking at trades like this and we're able to identify a sideways ranging market, right? This here is where we're going to start looking at entering positions in the market, right? Or, if we're a buyer, right? And if we're a seller, this here is going to be the areas in which we want to start selling the markets, right? And where we buying and selling this to? If we're buying this, right? We're targeting this zone right here. And if we're selling this, we are targeting this zone right here, right? And it's as simple as that, right? And why is that? Is because if we are wrong on the trade, let's say for example, if we went long down here in the first square and we're wrong, we get out somewhere around here. If we went short up here in the second square, we would get out somewhere right here, right when the market breaks, right? And why is that? Is because even though we do see overshoots, so we do see these types of things happening in the markets, overshoots and undershoots, right? This is what drives a lot of trading crazy, because again, um, people who are setting up their risk rewards like this, right? They realize that the moment they got shaken out, or let's say the red square is our risk and we're going to be getting out there, the moment we get out there, these undershoots reverse and they go back down. So on a trade like this, we would have been taken out, right? Or on a trade like this, we would have been taken out only to see the markets come back. But then again, do we want to be participating or do we want to be in the market when it's doing something like this, pulling back down very hard like this and then coming back up very hard like this, right? The idea here is to manage our risk properly. And so even though we may have gotten shaken out in the markets, we have to suck it up and take a small loss and live to fight another day. All right. Okay. I believe this is the last one. So again, Luke, there's a lot going on here. Can you explain your thought process, please?
Um, and right here I saw a consolidation of pricing going on.
Mm-hmm.
But then, like you said, this is like a bull wedge. If it was a real bull wedge, it should have broken to going up, right?
Mm-hmm. Yeah. So it's
It's
another
only
again
like
another fake breakout.
ah,
Yeah.
um, and then oh yeah, so I have a resistance line down here.
Yeah. Yeah. That's a support. We call those supports when they're at the bottom.
Yeah, support and resistance here. And
Uh-huh.
Not sure why I have this line here anymore. I don't know. I see 4 and 2 in here, but
you,
I'm not sure.
you see why it's important to come back to the
Oh, okay.
charts that you draw in a couple of days when you reanalyze them.
I think this line up here was the neck of this head and shoulder. I saw that circle there, but
Okay, I don't really see a head and shoulder there on that one.
can we move the chart more on
I'm sorry.
the can you pull the chart or is that it? Like the that little circle, you see a piece of it right here, but is there any
I
chance we can pull the chart this way?
Let me see 1 second because I got all these charts from. Oh, right. Okay. Yeah. So, um, let me see. Give me 1 second. 1 second here. So I'm gonna need this back.
Maybe it's my when I send it to you, I cropped it too close.
Oh, no. This is my fault. I kind of cut off that picture. So just give me 1 second. I'm gonna put that there for you. There you go.
Oh,
There you go.
so now yeah, after talking to you with the other charts, I've realized this is not really a good head and shoulder, is it?
I would say this is more of a megaphone pattern.
Yeah,
Yeah, so again, like your Head and Shoulders, Luke. So let me take the presentation status again from you away for 1 second here. But Head and Shoulders typically look something like this, right? Uh, where, oops, they typically look something like this. This is what we're looking for, right? Very good Head and Shoulders have something similar to this, right? Where your left shoulder is actually smaller or taller than your right shoulder. Sorry. So like you see where this level here is higher than this level here, this becomes an even stronger head and shoulder, right? But in
yeah,
your case, the in your specific case, the shoulder did something like this, right? And it
yeah,
it pulled back and then it just went like that. You know, that's no longer a head
yeah.
and shoulder.
Right.
Okay.
Yeah,
All right, so just from looking at your charts very quickly, um, I do agree with you. Wedging pattern right here, definitely. Definitely wedging pattern of consolidation there. And again, once that broke out, where's it gonna go? It's gonna try to go and hold onto a support level, right? So you have that support zone right there. Um, Other than that, I see this here in the markets too, right? And in a megaphone pattern like this, you remember megaphone patterns like this?
yeah,
They typically break to the downside, right? When they break
mm,
out. And so we do see something like this in terms of volatility. But again, we don't know, like this is just in general what they're expected to do. And markets don't always do what's expected to do, right? So that's the reason why, we can even look at, something like this here and say, oh, I see a wedging pattern here. Um, it's supposed to break to the upside, right? And it doesn't.
right.
Right, so it's important to take note of these things when we're trading. Okay, so let me go back here and this. Okay, so now we're back here. Okay, So any other questions? I hope you understand how to interpret patterns a little bit better and whatnot. I think like me taking up some of your homework and providing you with feedback on a basis like this works really well. What do you think?
Yeah, I agree.
Yeah.
It
So
would
so
be even nicer if it was possible to actually do that live.
to,
Go on
to
the real chart when it's actually moving and just go, okay, what do you see? What's happening? I
Oh
see
yeah,
this, whatever.
yeah, definitely. I believe next week we're gonna figure out a way in which we can trade lives like this, right? So next
Sweet.
week will be on Thursday will be our sixth class, and in our sixth class is a review and then a trading session. So we're gonna figure out how to like screen share my screen and your screen and analyze the charts and draw on the charts as they're performing in real time. So
Awesome.
we're gonna figure out a way to make that happen. Okay. But anyways, I really like this format. I think it makes it very much more interactive, and I think you learn a lot more from this from me giving you feedback on your homework. Okay. So, anyways, moving on with today's class. Today's fourth class that we have together, module number 4, and today we're going to be talking about the macro and micro fundamentals of the economy, as well as trading news and whatnot. FYI, this is my background. My background is in macro fundamentals. So I know quite a bit. I feel very comfortable talking about economic data and performance metrics from an economy, as well as central bank monetary policies and their effects on the economy and the stock market, as well as fiscal policies from governments and how they impact financial markets, and then ultimately how they impact, the shares that we trade, right? So obviously, a good example of that today is Apple being the first trillion-dollar company trading in the world right now. Right? This is the first time ever a company has hit $1 trillion valuation. And so, how is the macro environment set up so that Apple was able to meet these targets? How was the fiscal environment set up so Apple was able to do reach these targets? How was a micro environment inducive of Apple reaching all of this, right? The short answer is from the US side, specifically from the government, you have the Trump administration cutting taxes. You have the Trump administration allowing Apple to repatriate hundreds of billions of dollars of money overseas back into the country. From the macro side, you have the US economy picking up based upon certain metrics such as like employment, spending, and whatnot. That's all positive for a company like Apple, which sells consumer electronic goods. And then from the micro fundamental side, you had Apple releasing their earnings, I believe it was like a day ago or 2 days ago, and their earnings calls even suggested that Apple was selling iPhones at a higher pace, and they were earning more dollars per revenue or sorry, per share than what analysts was expecting, right? And because of this, Apple spiked up in their opening sessions the following day. They were trading near the $200 mark, which was very close to the $1 trillion evaluation. And as such, the $1 trillion evaluation mark, which was deemed by the market to be Apple at $207, was the $1 trillion mark. Well, guess what happens to market psychology when everybody knows that, hey, if Apple hits $207, they'll be the first ever traded company that has a $1 trillion market capitalization. What happens? Everybody hears it, everybody gets excited, everybody starts buying because we all like a good story. Everybody starts buying Apple shares, driving up the prices, and then eventually Apple hits that target and then becomes the first ever $1 trillion traded company. Very likely, in my opinion, is that I believe we're going to start seeing some short selling in Apple or profit taking in Apple around that $1 trillion mark. But again, that is just my belief, and we will, wait to see in the next couple of days what will actually happen to the shares of Apple. Okay. So I hope you guys enjoy today's module. I know I certainly do enjoy this topic and I love talking about this topic. Hopefully you guys can take away some good information that will help you set up trades. All right. So on the agenda today, we're going to be discussing micro fundamentals as well as trading news. We're also going to be looking at macro fundamentals and also understanding sentiment. So today's topic is going to be less chart heavy and more theoretical and academic, right? So hopefully you guys still follow along. All right. So micro fundamentals. Micro fundamentals is essentially the study of a company, a sector, or an industry. When you're looking at micro fundamentals, you're looking at how well a company is performing and all the metrics that goes into calculating the performance of one specific company within the entire broader economy. So when you're looking at micro fundamentals in trading, we're looking at specific information related to that company, that sector that will give us an edge in trading or investing. So, an example of this is that an example of micro fundamental trading is that when we're looking at shares of Tesla, right, we're looking at how much Model 3 vehicle productions Tesla is meeting quarter over quarter and whether or not they will beat those metrics based upon analysts' expectations. Right. When we're looking at a company like Apple, we're looking at how much iPhone sales are they selling quarter over quarter. When you're looking at a company like Netflix or Amazon, you may look at how much Netflix subscriptions is increasing or decreasing from quarter to quarter, or how much Amazon Prime subscription is increasing quarter to quarter. Well, Amazon's not a great example because they're such a broad business, but companies like Spotify, for example, who's more in the music subscription business, right? That becomes an integral part of their company. And so when you're looking at whether or not these companies will grow over time, you start looking at how much subscriber usage do they have, right? Facebook is another example with user retention and how much time people spend on Facebook and how much users they're adding into their platform, right? This becomes an important part of their business. When you're looking at companies like Coca-Cola, you're looking at how much Coca-Cola they're selling. Quarter over quarter, and that's how you essentially analyze a company's performance from a micro fundamentals perspective. Although this is a very narrow range, there's many other ways of analyzing performances of specific companies. Typically, the primary service or business that they're in becomes the focal point of looking at how to analyze how much a company is performing. Right. And what I mean by that is that companies will move based on things such as like the change in shifts within a CEO, any scandals that the company may be involved in, any litigations that a company may be involved in will affect their stock price. You know, in addition to that, any regulations that gets implemented within the sector or the industry that that company is trading will affect the stock price. A good example of this lately is that you've been hearing a lot of deregulation of the marijuana business, and so now you're starting to see a lot of marijuana companies popping up, a lot of mergers and acquisitions taking place, a lot more people are getting euphoric about this specific sector, and so you get a lot more buying and selling activities taking place, and that just leads to a stronger demand for this particular sector and stronger demands for shares of companies operating in this sector. Okay, so in addition to what I've just mentioned, you also have a lot of like financial releases, financial books of a company that give you a sense of how well they're performing within the markets. So this is basically analyzing the financials or the books of a company. You can look at all types of ratios such as like earnings per share, debt to earnings ratio, the quick ratios, and all these other financial ratios and modelings to get a sense of how well they're performing on their bottom line from an accounting's point of view. So all of these things goes into play when you're looking at analyzing one specific company, which encompasses the field of micro fundamentals. Have I lost you? Anybody there?
No? Hmm?
No? Okay, good. Okay. So companies in different sectors will have different metrics that affects the values of their shares. And I just mentioned this point. One company that I did mention was McDonald's. McDonald's, like Starbucks and whatnot, they care quite a bit about same store sales. That becomes quite important for them. It's also important to understand when the markets position themselves to trade these variables, they're always trading what the actual numbers are, versus what the market's expecting, right? So I'm pretty sure you've heard of earnings releases, and prior to earnings releases, you get a lot of analysts who essentially give out their expected numbers, right? So let's say Apple is expected to earn $3 per share, right? That becomes an analyst expectation, and the markets will move based upon the miss or beat in that expectation, right? So it is a deviation away from that expected number that will cause markets to move, right? A very good example of this is that, let's say the market was expecting that Apple was going to be selling 10 million iPhone X for the first quarter, right? And so that becomes the inherent expectation for Apple. And when the actual numbers is released by Apple through their earnings reports, and they'll say, "Oh, we've sold 10.7 million iPhone X, 700,000 more iPhone X than what market analysts were expecting," right? That's what causes the additional drive in prices, right? Vice versa, you could say if analysts are expecting 10 million in Apple iPhone sales, and Apple releases their actual numbers, and the actual numbers comes out as 9 million iPhone sales, well, that completely misses analyst expectations, and the stock of Apple will drop in prices. So it's very important to understand that concept, that the market will build or will rally around an inherent expectation. So the price of an asset will ride to or come to a fair market value point in which the expectation is built into the price. So if Apple, in their previous quarter's earning was trading near $190, right, leading into their earnings report, that $190, for example, is building into the expectation that Apple will meet certain expectations or the stated expectation by analysts. Any additional beat on expectation would cause those share prices of $190 to trade higher, and any miss on expectation will cause those share prices to trade lower. Okay? Are you guys following me? Is there any
Yeah.
confusion here about this point?
Fine.
Do you guys have any confusion about this point? This point is what I often refer to as expectation theory, right? It's expectation theory that drives the market. What's expected, not what actually happened, right? Because it is concept in which, when you hear about something in the markets typically gets driven based upon that fact, or not sorry, doesn't even have to be a fact. It could be a rumor, right? Let's say, for example, right now, Tim Cook, the CEO of Apple, is rumored to be stepping down from his position as a CEO, right? It could be a rumor that is floating around in newswires right now. That rumor would cause share prices to start dropping right away, right? And when the fact comes out, let's say a day later, Tim Cook comes out and says, "Hey, I am stepping down as the chairman of Apple." right? Because those share prices have already sold off to price in the fact that Tim Cook is no longer going to be CEO. When the facts come out, the share prices shouldn't even move. In fact, a lot of times the share prices would do the opposite. So it would be a relief rally in the prices after Tim Cook has come out and stated to the markets, fact, I am leaving my post as the CEO of Apple. The share prices of Apple will more likely rally from that point than continue to sell off. That is the whole concept of expectation theory. The market takes in information, whether it's true or not, it could be a rumor, and then it builds the share price around that rumor. Once the actual statement comes out, the opposite happens. And this is often called, the buy the rumor, sell the news type of mantra. That is basically what drives expectation theory. Okay, so micro fundamental topics that may affect stock prices. So we have changes in CEOs and management change, earnings reports and metrics reports, rules, regulations, product offerings, service offerings, intellectual IPs, partnerships and joint ventures with different companies. All of these types of things will affect the price of a stock, especially if it's new, right? And I'll give you a very good example of this. A while back, there was a company called, and I don't know if you heard of this, Luke. It was called Long Island Ice Tea. Have you heard of this
Yeah.
company, Luke?
I know of the drink, not the company.
Long Island Ice Tea. You know the drink?
Yeah.
Okay, perfect. That's okay. You don't need to know much about the company, right? You just have to know about the drink. Long Island Ice Tea, the soft drink company, decided that because of the whole cryptomania phase, right? You heard of cryptocurrencies? Because of the cryptocurrency phase, they wanted to change their name into Long Island Blockchain to take advantage of the trend that was in the markets, right? And because of this, their share price spiked up like crazy because they basically took advantage of they took advantage of what was happening in the markets. So, okay, I'm not able to find it here. So, right? But that was the essential idea, was that they took advantage of what was going on in the markets back in December, January, the whole phenomenon, the tulip bubble, the craziness that was going on with Bitcoin and other cryptocurrency assets that were gaining value like crazy day over day. So they took advantage of that and changed their name from Long Island Iced Tea to Long Island Blockchain. And because of this, their share prices skyrocketed. Right? And so this is an example of how companies are able to manipulate the current trends in the markets and take advantage of what's happening to essentially create more shareholder value through the appreciation of their shares. All right, and I'm gonna find a story of this. I'm gonna find this on the web, and I'm gonna share it with you. If you're not familiar with this, you're not familiar with this. I take it, Luke.
No, but it's crazy to me that just by changing their name, that's all it took. It's crazy.
Yeah, and I'm pretty sure you've heard of cryptocurrencies and the bitcoins and whatnot by now.
Yeah.
Okay, yeah, so exactly, right? So, I mean, there was this whole phase and era in which, cryptocurrencies were stagnant, and through a couple of months, they were, going through a phase of euphoria, and Bitcoin just went parabolic and skyrocketed, and because of this, all other cryptocurrencies were skyrocketing as well, and they took advantage. So this soft drink company took advantage of what's happening in the markets and just changed their name. And because of that name change, their share prices skyrocketed. I believe it was like 40% or something like that. So it was an astronomical amount. Um, I will find that and I will share it with you. Okay. So one important key thing that we must understand as day traders. So share prices move based on supply and demand, especially during the day. Okay, so you know, a lot of these things here, a lot of these key points here that I've mentioned before here can have longer term macro fundamentals effects, right? Like in the short term, the markets, like on a daily basis, will either open here, right, and skyrocket up like crazy, or if it's like an earnings number, what will happen is that they could the previous day close here, and then the next day gap open here, right? And you'll see like a large gap in the price where the price will jump like maybe $10 because of any one of these metrics here. A CEO change, rules and regulations, new product offering, or something new that the company has been brewing up that hasn't been known to the markets. This can cause a flurry of action on an intraday effect. Right. So this is how we take advantage of it on an intraday. However, a lot of times these key changes here will also lead to longer term effects, right? And so it's very important to understand that when we're trading during the day, we're trading on the price action, the supply and demand of these prices during the day. Okay. Um, Fair market value for the price of these shares may be disregarded as the market pushes the price and pulls the price of the share. All right. So what I want to get out of here, and specifically with this point, is that longer term, these fundamental changes in the companies will have a impact in the markets. Like it will cause the market of this specific stock to trend up or trend down in the long run. However, on the short term, the moment the news comes out, you may have an immediate impact in which you are able to take advantage of, especially when you're trading within the Toro Challenge itself. Okay, so oftentimes here the market the market will begin to price in fundamental news ahead of time, right? And again, this happens quite often when we're looking at earnings seasons. So, for example, Apple shares, if you looked the day before Apple's earnings was released, you can see Apple shares were rallying with the markets, right? Same thing with Tesla. Same thing with any upbeat expectations for a company is that they may begin to price in certain elements of these expectations prior to the actual release. Okay, market forces are traded erratically, and oftentimes fair market value of a share can be completely ignored. All right, so this again, back to my Long Island iced tea example, this is an example of erratic market behavior, and fair market value of that particular company was completely disregarded. Because why would a company, just for the sake of changing their name, have no bearings on which has no bearings on their operating business, all of a sudden experience a 40% spike in their share prices, right? And that's because of the erratic behaviors of the markets, the irrationalities, the market exuberance that causes share prices to get out of line with fair market value. Okay, so just some quick equity indexes for you around the world. So around the world, there are several large indexes which you should take note of because they can provide you with very good information about what's going on around the world and more specifically how that begins to trickle down and affect the markets that you're trading, right? So around the world, you have the MSCI World Index as well as the Global 100 Index, which or sorry, the S&P Global 100 Index, which represents 100 of the largest companies traded in the world. And then you have on a national level indexes like the S&P 500, the Dow Jones Industrial Average in the U.S. In Tokyo, you have the Nikkei. In Europe, you have the FTSE 100. Regional indexes. An example of this is the FTSE Developed Asian Pacific Index, which only tracks companies that are trading um, sorry, only trading in Asia. And then you have exchange base index, which is like the Nasdaq 100, which represents 100 of the largest companies traded on the Nasdaq or the New York Stock Exchange 100, which represents the 100 largest companies traded on the New York Stock Exchange. Now, how is this information useful for you? Because the world is very interconnected, sentiment information can be taken from the movements in these markets, right? So for example, if the global economy is not doing well, or if the sentiment on the US economy is not doing well, then the pressure in this particular market will start leading downwards, right? From a global perspective. And then as you're looking at companies within the country that you're trading at, because all these companies, for the most part, they do deal and have businesses with other countries and other economies around the world. If the global indexes are not doing well, then guess what? These indexes will be typically being pushed to the downside as well. All right. And so when you're looking at the individual stock that you're trading, so let's say, for example, when you're trading MU, you're trading this ticker, right? And up here you have the global index not doing so well, and then you have your national index not doing so well. Well, guess what? MU may not be performing that well on the day, right? And this is how you essentially derived indexing information and using this indexing information to help you trade the individual stocks. Okay? So why is the S&P 500 so important? Specifically within the Toro Challenge, it's very, very important to look at the S&P 500 because it represents the 500 companies in the United States with the largest capitalization. And because of this, it basically represents about 80% of the total value of the US stock market. It's a very, very good barometer of how well corporate America is doing from a fundamentals perspective. And you can look at individual stocks based on how data affects a particular sector. So, for example, the price of oil versus oil producers like BP, Exxon, etc. Right? What you can take away from this information is that, you know, assets or commodities like oil will directly affect the share prices of companies like BP and Exxon, which would then, based upon the beta, would exert influence on how the indexes are performing. Okay, and vice versa. If you know 90% of the companies within the S&P 500 is selling off, right? There's a very strong chance that the companies or the stocks that you're trading is likely to follow suit with the indexes as well. So equity index valuation methods. You have price weighted indexes. So the Dow Jones is an example of a price weighted index where it's weighing in the price of the 30 largest companies traded in the Dow Jones Industrial Average. And then you have market capitalization weighted index, which is based upon the size of the outstanding shares. So the valuation of the companies based upon the outstanding shares as traded. So here you have your market sectors, and I'm pretty sure by now you've come very comfortable with the market sectors here, and you probably know which sector you typically lean towards. Would you like to share which sector you guys typically like to trade?
Don't have one yet. Still searching.
You're still searching?
Yeah.
Typically, most people I know they lean towards the tech sector. So, it's typically I would say it's typically a combination of IT or consumer discretionary or even consumer staples, right? So, for example, people like to lean towards like companies like Apple because they're very familiar with it. And Apple is an IT company, but it's also in consumer discretionaries and consumer staples as well. I've always mentioned this because it's important to understand which sector you participate in because the sector you participate in will allow you to hone down into the fundamentals that more so drive that sector, right? So, I'll give you an example. Sector like energy is highly driven by commodity prices. It's driven by the fundamentals of what's going on in terms of the US dollar because most commodity prices are priced in US dollars. It's also driven quite a bit by the fact that it has a lot of um, micro fundamental factors that affect how much a company can produce in terms of the energy that they're drawing out of the market or drawing out of the ground, but in relations to how costly that energy is being pulled out of the ground also affects it as well. Okay, so one of the things that you should do, Luke, is you should start looking at, like what individual companies that you like to trade or that you lean towards, and look at what sector they operate in. So you have your primary and your secondary markets. Your primary market is basically when a market goes from a private company to a public company in the forms of an IPO. Right? And then once it goes through this process, it then gets traded in the markets, which then becomes a secondary market. And I believe, if I'm not mistaken, we've already covered primary and secondary markets in the past. Yes.
Yeah, we're only going to trade secondary, right?
Yeah, yeah, exactly, right. So the primary market is more for underwriters and for bankers who essentially help a private company get taken into the markets, get taken through that process. And as they go through that process, the banks that are helping them typically get first dibs on the share prices that they're about to release to the markets. And so, if you're not an insider, it's very difficult to access the IPO market. Right? So that's why we primarily trade on the secondary market.
You are now muted. You are now unmuted.
So market capitalization and earnings. A company's market capitalization is the current stock price multiplied by its number of outstanding shares. So, a strong factor influencing stock price is the company's earnings. The SEC requires publicly traded companies to release their earnings quarterly. This is very, very important because this is a trait of all publicly traded companies. Most companies release their earnings in 3 month intervals. So you get January, April, July, October, right? And they can vary in dates, but they typically do it in 3 month increments, so in quarterly increments, and they can basically choose when the start month will be for those quarterly increments, so they don't have to all be set on this specific date. So trading news, it's very important to be connected to proper news feeds. Um, we're gonna have an entire section on setting up proper news feeds. So just real quick right now, I just want to ask you: do you use any types of news feeds at all, Luke or Khalid or Eric?
No,
No,
good.
you
No, I
don't. You
don't even know where that was.
okay? So like you don't listen to like Bloomberg or CNBC or BNN or anything like that?
Nothing.
Nothing.
Tell me, what should I be listening to?
Oh, okay. Well, just for simplicity's sake, I would start with just like something like CNBC when you're trading. It gets you in that trading vibe, So that's always a good start, right? But anyways, we'll talk more about proper news feeds and whatnot. So do you do any research at all on the internet for companies and whatnot?
No, like I said, that's one of the reasons I didn't start trading is because I'm not sure. I don't know any of this stuff like news feeds, what should I be doing, you know?
Okay, perfect, perfect, perfect. Okay, so that's fine. That's what I'm here for, and that's what I'm here to help for, right? So, why is it important to have a news feed, right? Having a news feed, something as simple as an internet connection to a website that constantly spits out RSS news feeds and whatnot. Number one, it helps you stay connected to the markets, right? Especially the markets that you're trading, such as the North American stock market. Number two, news feeds can alert you on opportunities or on events, risk events in which you can participate or avoid trading, right? So let's say, for example, you know that there's going to be a big Trump speech coming up at 1 in the afternoon, right? Well, if Trump is talking about, tariffs on electronics coming from China, and you're here in front of your computer trading Apple, well, you know what? Apple does a lot of business and produces a lot of their products from China. So if Trump is going to be imposing tariffs on these electronic goods that are coming in from China, then the share prices of Apple may be affected by this. And so that is why it's very important to at least be conscious of these events that are taking place and understand that these events can either be avoided or they can be traded, right? So if you understand how to maneuver around these events, you can view these events as opportunities to trade them. Or if you don't understand these events well enough, at least be aware that at this specific time, something big may come out and you may not want to be in a position while this is happening because you put yourself at risk of that additional volatility. Okay? Oftentimes, When these events come out, stock prices can move very, very fast. I used to trade in the futures market, and we used to trade oil data. We used to trade, economic release information from the U.S. economy, such as like non-farm payrolls and retail sales. And I can tell you, these companies, especially high-frequency trading firms, they have microwave technology in which they get data and execute trades within the nanoseconds, right? And so the moment you blink an eye, the price of a share or the price of a futures contract or the price of a currency can be, you know, 10 10% higher in the case of a share, or in the case of the forex market, it could be like 90 pips higher than where it traded, based upon the events that have came out. Right, so it becomes very important to understand these events and either prepare and view them as opportunities, or be aware and view them as times to avoid having open positions. Okay. Okay, so you need to understand how news will impact the price of stocks, positive or negative, right? So again, common sense. I mean, I've never been able to, like describe this way in a very complex manner, but I would say it's just common sense, right? Let's say, for example, just to test you really quickly, um, let's say Donald Trump looks at rolling back the tariffs that he once thought of imposing on Chinese goods for the electronic sector. What would happen to share prices of Apple? What do you think would happen to share price of Apple?
Yeah.
Not if they're rolling back. They would go up in this case, right? Because if Trump, if Donald Trump previously stated that he was looking at imposing high tariffs on goods, electronic goods being imported from China, right? That statement right there would cause stocks to go down, or especially shares of Apple to go down. However, if a new statement came out and says Donald Trump looks willing to roll back trade tariffs on electronic goods being imported from China, that in that case, that news would be positive, right?
Or rollback means a takeaway. Yeah.
Yes,
Okay. Now it
exactly.
makes sense.
Exactly, right? So it's very important to understand how to interpret the information that's being released and then use the information to help you position yourself to trade it, right? Or at least, going back to my other point, avoid the event. Okay? So here's an example. All right, here's an example. Twitter. Twitter CEO announces they're removing 70 million accounts, right? The market views this as a negative, and then the stock drops by 9%, right? Why would the market view this as negative? Is because Twitter is now losing 70 million users, 70 million accounts. On the face value, just reading this headline, right? Do you think this is good news or bad news?
Bad. Yeah.
Bad news for Twitter, right? And so the market views this as negative, and massive selling begins to take place. And so look what happens to Twitter on the day. You know, has a massive selling taking place. And a 9% drop in Twitter was about, I believe it was about $5 or $6 drop in one day.
Okay.
Okay. And I also threw this in here because I know you guys like Fibonacci's quite a bit. So you guys can see here, Fibonacci's, while we're on this topic, is very good when we're trading news. So you can see here, you have your highs and your lows, and then you have your 50% mark right here, and that's your 38%. And that's your 61% right there. So you can see here, Luke, are you familiar with Fibonacci's? I believe you did say you were familiar, right?
I said I was intrigued, but I'm not that familiar.
Okay, okay. So we again, Fibonacci's is a topic that we'll cover in one of the upcoming classes. But again, Fibonacci's is something that we can use to help us um, establish levels when levels are hard to define, right? Or when large moves like this, where you have a large gap move in the price of a share, right? Fibonacci's will act as places of contention in which the price will likely bounce or break through to reach to the next level, based upon the Fibonacci ratios. Okay, so you can see here on this, it's quite interesting taking a look at the Twitter example and how it reacted to that. Here's another one. My beloved MU stock. So China announces it will retaliate against U.S. tariffs by imposing. Uh, sorry. China announces it will retaliate against U.S. tariffs by imposing tariffs on U.S. semiconductor chip maker Micron Technologies. Right. Obviously, when you hear a headline like that, you know it is not good. Right. You know this is not good. Okay, and the tariff is viewed as negative for MU, and guess what? MU shares drop 8% on the day. And so here we can see the extreme volatility taking place on the semiconductor, right? And as you can see, it took place in this era right here, right? But as you can see, the moment that news came out, and also take note here, that news came out roughly just before noon. So it could happen anytime. And this is why it's very important to stay connected to a news wire or TV or even an internet, news subscription, which will provide you with information on what's going on in the markets. Because, even though this can be classified, this specific thing here can be classified as a government policy, right? So, Chinese government announces they'll retaliate, right? So this is directly coming from the state of China, and they are attacking a U.S. company, right? And so this here caused them to drop massively. And this is all coming through their fiscal policy or their stance, or their retaliation against U.S. tariffs. And this is an example of why it is very, very important to have some kind of connection to a news wire or a news feed to get a sense of what's going on. All right. So, before I move on to here, I just want to say there are many, many other examples of news headlines and whatnot, and news trading. News trading causes strong, strong volatilities in the market, and I can't say this enough. If you understand how to approach it, you view it as an opportunity to trade the markets. If you don't understand how to approach it, at least be aware of it and avoid it so that you don't take catastrophic losses, right? This here was an example. And actually, to tell you guys the truth, I pulled up this example specifically because I had a long position on MU right around here, when I was trading in the Toro Challenge, and then all of a sudden, the auto flatter on the Toro Challenge hit, and before I knew it, MU was trading like about $3 down lower. And the moment I saw that, I automatically knew that this was a news related event because this is a stock that I typically trade. And so I know that, it will not have a $1, $2 fluctuation in a matter of seconds without some type of catalyst, right? And so the moment the auto flatter came in and took me out, I knew that this was something up. Something is up with the news. Why would I get knocked out of this trade if it wasn't, you know, if it was just a normal trading day? Because no day in the past has MU behaved like this. So today must be a special occasion. And so, upon doing some research very fast, I realized that the Chinese government came out with headlines uh, minutes earlier stating that they're going to be imposing tariffs on Micron Technologies. And because I wasn't properly connected to this, I took a loss on this trade. And so, this is a personal example that I wanted to share with you and let you guys know why specifically this example of news trading is so important. And there's so many examples of this, right? And it doesn't have to be around tariffs and regulations. It could be around something as stupid as changing your name from Long Island Iced Tea to Long Island Blockchain. Right, so these news events take place all the time, and they can be used as opportunities. All right, moving forward. Any questions so far?
Yeah,
Yes, go ahead, Luke.
um, I'm listening to all this. It seems really difficult to trade more than one or two stocks at a time if you want to be really familiar with them.
Yes, you're absolutely right. It is difficult.
So,
Yeah, go on. Finish your point before I jump in. Sorry about that.
oh, it's just like I made a little list of six, seven or eight different stocks. I'm trying to figure out which one I would like to trade. But
Yes.
again, if I want to be connected, over the news about that company and everything, maybe one, two max.
Yeah. So here's my take on that point. I like it that you narrowed it down to like less than 10 stocks that you want to trade, right? What you're gonna find over time is that the style that you come up with trading may not be applicable to one or two of those stocks that you were having success with in the past. And so you need to move on to another stock that you're comfortable and familiar with and then apply that strategy to that stock. This is why you should have like a list of, of a handful of stocks that you want to look at, right? But not have open positions on several stocks at the same time, if that makes sense.
Yeah,
Yeah. So what you want to do is you want to be trading, actively trading with open positions on maybe, one, two, maximum three. And I say this because you're new to trading. I do know some people, some traders who are able to manage several trades at the same time, several open positions on different products at the same time. However, their experience is on a different level, and their trading style is something unique to trading multiple assets at the same time. Okay, whereas for a new trader, it requires a certain level of attentiveness to be able to focus on successfully trading several different open positions at the same time. So it becomes more difficult. So before you get to that and wanting to test that out, try it with one stock first and see how you're able to manage just one stock. If you're able to perform well and do that well, then maybe your trading style or your plan is to trade several stocks at once. And so by all means go for it. Right? But before you jump in, just be aware that having several open positions requires a different level of attention span that if you're not fully prepared for, you may not be able to do it. Okay?
I wonder how long it will take to find a trading style.
I think of trading in terms of phases. right? So there's essentially three phases to trading. So the first phase of your trading career is education and exploration, right? Education in the sense of like what we're doing right now, Luke, where we are learning about the basics of the markets. And as we've been going through the last couple of days, I'm pretty sure after every module that we covered, you're probably sweating like, oh, thank God this is over. This is so overwhelming, right? That's how the market is, right? There's so much to learn. There's so much micro fundamentals. There's so much macro fundamentals. Then you have to learn central banks. Then you have to learn technical analysis. Then you have to learn how to look at charts. Then you have to learn how to apply risk management. Then you have to learn how to manage your own psychology. Then you have to learn how to come up with a style that will encompass everything that you've learned with the products that you're trading. Then you have to figure out how to be consistent, right? That's just the first phase. The second
Totally, totally.
phase of trading, right? And mind you, I didn't give you a timeline yet, but the second phase of trading is figuring out how to be consistent in your trading. So the second phase is characterized by more knowledge or at least extensive knowledge of the market, more knowledge of the products that you specifically trade, and honing it down to I'm a futures trader, or I'm a stock trader, or I'm a cryptocurrency trader, or I'm a forex trader. You have to hone that down because there's so much things you can trade, right? After that, it's figuring out the balance between your personality and the style of trading you want to use. So if you're a person that can only trade for 2 hours a day because you have business and family obligations and you can only sit in front of your screen from 7 to 9, well, then that's what you have to work with. Or if you're the person that likes to put on a trade, put in a stop loss, then go out with a friend, have coffee, go out for dinner, take a nice nap, look at your trade 2, 3 days later, right? That's a different style of trading. And that phase in itself, figuring out your style, your personality, how to apply it to the products that you're trading, right? And then more importantly, in the second phase is how to make it consistent becomes very, very difficult, right? That's the second phase. The third phase and the final phase is, I call this phase the sizing up phase, right? This is when you've learned, you've gone through phase one, you've learned all the basics, you understand it. Then you've gone through phase two, you know your style, you know your product, you know everything there is to know about yourself and how you trade your product. And you're consistent in the ability to make money in trading your product. The third phase is how do you scale up your style and your consistency and make as much money as you can from the markets. Because in the markets, there's no limitations to how much money you can make. The only limitation is restricted upon yourself, right? And so in the last phase, this is where you go from, I make several $250 a day trading to now I'm making $2,000 a day trading to I'm making $20,000 a week trading to I'm making $200,000 a month in trading, right? Just by applying the same techniques and the same style that you've once learned and mastered in the past, by applying this to the products that you know how to trade and managing it with proper risk management, with proper balance of your psychology and mental health, and sizing up. That is the last phase, right? And not once did I mention any timelines on how each person will get through any phase. The reason being is because everybody learns at a different pace. So phase one could be as fast as completing this 6 week course for you, or it could be the beginning for you, and you are going to get more books and enroll to another program and trade and learn, and that phase one for you could be another 2, 3 years. Phase two in itself, that whole exploration phase of learning how to come up with your own style and make it consistent can take you quite a bit of time and it's different for everybody, right? And then the phase three is the phase in which you've understand the markets and now you're just reaping the rewards of everything and all the efforts that you put in the past. And all these phases are very different, and it's very important to understand which phase you're in and not to confuse the phases that you're in. Okay?
Does that work with the Toro challenge? Because you only have 3 months. What happens is after 3 months you kill phase one and
Well, you
no?
you can always reset. You can always reset, or you can always go back into the Toro challenge. Right? And within the Toro Challenge itself, the Toro Challenge, this is really designed for somebody who was in phase two, the Toro Challenge, right? For somebody like yourself, using the Toro Challenge risk management parameters is a fast way to learn how to manage risk and manage drawdowns, but at the same time also understand the markets as well and learn how to position yourself to trade the markets properly. Does that make sense?
So,
I'm sorry?
so maybe as a so maybe as a brand new person, the Toro challenge was not the right way to go.
I wouldn't necessarily say it's not the right way to go. It is still a very good learning experience for yourself, right? I mean, like, you're learning quite a bit um, about how the markets work and about how to position yourselves from a fundamentals perspective, and more importantly from a risk management perspective, setting up trades and whatnot. And so I really have to encourage you to actually start putting on trades and applying some of the techniques and whatnot that we have been doing, to get a better sense of how to position yourselves to trade. Okay. Hello.
Yeah.
Okay, so moving forward, macro fundamental analysis is essentially an overview of how well an economy is performing by understanding key economic measurements used to gauge the health of a particular economy. Economic fundamentals are the data which retail traders, institutional investors, hedge funds use to formulate their trading slash investing thesis. Central bankers also use this information to ensure the economy is performing as expected based upon the metrics and forward guidance. So I'm just going to go through this. In the US, and this not only applies to the US, but this also applies to most G7, G8 economies in the world. They gauge their economies by studying these key points here. So you have growth, you have inflation, you have production and services, you have housing, you have employment, and you have confidence indicators. An economic calendar. So an economic calendar shows all the data and news-driven events that will take place for the week. Most of these events are released at 8:30 a.m. prior to the New York stock market opening. Um, this is important to understand because there is something referred to as a futures market, and there is a futures market for S&P 500 indexes as well as some stocks traded in the markets as well. And because this is trading 23
You are now
hours,
muted. You are now unmuted.
because this is trading 23 hours a day, it typically trades prior to the New York stock market opening. And what
You are
happens,
now muted.
geez,
You are now unmuted.
sorry about that. My microphone keeps cutting out. But as I was saying, because these releases are issued out prior to the stock market opening, they do affect the futures market, and the futures market would then be a good leading indicator on what you can expect to happen to indexes such as like the S&P 500 index, to stocks when they open at 9:30. So a easy way to look at this is that if data is released in the morning and that data is bad for the US economy, that would typically cause stocks to drop right away at 8:30 in the morning. 9 o'clock when the sorry 9:30 when the New York stock market opens, most stocks will open down to reflect the current sentiment. Which brings me to my last point here is that they these indexes and the release of this information sets the sentiment or the tone for the trading period. So it's important to understand the impacts of this. Uh, one last thing that I want to mention here is that if you want um, to go to a website that will give you information on economic calendars, this is the one that I like to use. Go here to investing.com and look for the tab that says economic calendar, right? You can also find earnings calendar here as well, right? So this website here, you just go to this website and look for the economic calendars and the earnings calendars, and this will give you very good information on if you're trading Alibaba and you want to know when their earnings are, you can find that here in the earnings calendar. If you want to see if there's any major economic releases this week, you can go to the economic calendar and it will show you all of the major events that are being released. So, types of economic indicators. So, these are all the types of economic indicators that I've mentioned. Let's go through some of these real fast. So, the first one is an employment indicator, non farm payrolls. It's a report that tracks the numbers of jobs created in the US month over month. It's released once per month, the first Friday of the month. So the actual next release of the non farm payrolls, believe it or not, is going to be released tomorrow. This indicator is highly market moving, meaning that if the US economy, for example, tomorrow releases its jobs numbers and these jobs numbers misses expectation, you're going to see a massive drop in the US stock market, especially in the futures market. And then if there's additional selling in the futures market going into the New York stock market opening, you will see that being reflected there. So this one's very important because again, another key reason why it's important is because jobs, jobs are the primary driver of the US economy. If citizens have jobs, citizens are spending. If citizens are spending, they're spending it on the economy. If the economy is growing, it typically means a lot of the companies that provide the products and services that foster a growing economy is likely to go up, and vice versa. Gross domestic product. GDP tracks whether an economy is growing or not. Economic growth will have a direct impact on the US stock market. This indicator is released on a monthly basis. So again, you can see these numbers being released on a monthly basis. And our nice friend Donald Trump was leaking out this information. The previous release. So I believe this information, GDP, was released last week. And prior to this, the market had already reacted. And the reason why it's reacted was there was rumors that the White House had leaked these numbers. Retail sales. So retail sales tracks how much the U.S. consumers are spending on retail goods. Because the US economy is driven by um, spending and consumption of goods and services, retail sales is essentially the backbone of US economic indicators. So if you have rising retail sales, that means people within the economy are more willing to buy, leading to a stronger economy. And if you have less spending, then that has the opposite effect. So consumer price index, this is an inflation indicator. It basically tracks the rise and falls of baskets of goods and services within the U.S. Inflation is a key metrics. So I want to highlight this is a key metrics that causes changes to Federal Reserve monetary policies. The Federal Reserve has one specific mandate. Their mandate is to make sure the price stability within the economy is stable. And by price stability, what they're referring to is that they don't want to see the price of goods and services that you're buying fluctuate wildly week over week. Right? A good example of price fluctuation. I'll just take an everyday example is that when you go to pump gas, your gas prices may be $1.30 today. Tomorrow it may be $1.40. The next day it may be $1.25. Right? That is an example of pricing fluctuations. What the Federal Reserve and all major central banks are mandated to do is that they want to control the price of goods and services so that they do not have this wild fluctuation in prices month over month. Gasoline, however, is an example of them not. Sorry, let me rephrase that. Gasoline and gas prices is an example of something that is not included in their basket of goods and services for tracking inflation. So it has a less of an impact. One last point that I want to mention here is that the policies at which the Federal Reserve uses to make adjustments will have a direct impact on the entire economy and the equities market. So the primary tool that the Federal Reserve uses is called the Fed funds rate, which is essentially a rate at short-term borrowings within the markets. So it's a rate for lending within the markets. That rate for lending will have a trickle effect within the economy, and when interest rates go up, it makes it harder to borrow within the stock market. So it makes borrowing much more costly. And as companies within the S&P 500 are heavily reliant on borrowing money, to fuel their growth. The higher interest rates are, the more costly it is for these companies to borrow money, and as such, money becomes tighter. The values of their shares begins to drop as well. ISM Manufacturing, it's this stands for the Institute of Supply Management. It's a manufacturing report that tracks the manufacturing health of the U.S. economy. The American economy, especially manufacturing, is seen as a bellwether for economic prosperity because it ties to a lot of jobs. And as such, when the prints on ISM manufacturing are strong, it shows a robust economy. When they're weak, it has the opposite effect. The University of Michigan's Sentiment Index. This tracks sentiment on U.S. consumers. So the way U.S. consumers feel about the economy will directly affect how they spend upon the economy. And a good example of this is that if I feel my job is more secure, 6 months from now, I feel like I'm going to get a raise, then I would be more likely to spend money right now rather than later. Vice versa, if I feel that my job is not secure and that my future is unknown, then that would cause a downward pressure on sentiment, and that would cause me and other consumers within the economy to be less likely to purchase now, deferring their purchase and spending much later until they feel more confident about the economy. And so that's why sentiment index becomes very important when it comes to trading on the day. It's important to understand when these indicators are released to the economy. Market participants are using this information and they're either taking a long or a short bet. So they're either optimistic by going long or they're pessimistic by going short. And as such, that sentiment, whether the positionings on certain asset is going up or down, can be used to help us make trading decisions on the stocks that we trade within the Toro Challenge. Okay, any questions so far about these indicators? There are much more indicators. These are just some of the broad categories of indicators that I'd go over quickly for this sake. Any questions on these indicators so far?
Um, if there's a way to find out, for example, you talked about the non-farm employment
Yep.
rate earlier. Um, is there, let's say, non-farm rate will impact this sector? Is there something like that? Like, which sector would it impact?
So that's a very good point, right? So non-farm payrolls will impact the indexes, right? And the index, because they are a broad representation of the overall market, will exert downward pressure on the overall market. However, I think this is where you're getting at, is that is there a sector that will be impacted more so based upon this? And the answer
Yeah,
is yes. So um, companies with that are much more risky, right? So like the tech sector, for example, is much more risky than say the utility sector, right? So companies such as like Apple will sell off more so than companies who are into utilities or telecom. Okay. Okay. Moving forward, what is a central bank? A central bank or a reserve bank or a monetary authority board is an institution that manages a country's currency, money supply, interest rates by setting monetary policies. All right. Good central banks need to be independent, credible, and transparent. Central banks typically oversee and regulate the commercial banking system of the country. The purpose of a central bank is to act as a lender of last resort, and they do that by printing money and issuing it out to banks within their systems. Some central banks act as a safekeeper for the country's reserve assets, holding gold, foreign treasury notes, foreign currencies, etc. So a central bank that does this is Sweden. They hold a lot of gold, the foreign treasury notes, and foreign currencies. Most central banks nowadays will only hold foreign currencies and foreign treasury notes. They don't typically hold as much gold. Central banks operate independently of the government, allowing them to set monetary policies for the country without interference by the current political party and the fiscal policies that may be implemented by that government. And I have to say, take this with a grain of salt because not all central banks operate independently. For example, the Bank of Japan does not operate independently of the Japanese government. The People's Bank of China does not operate independently of the Chinese government. And even in the US, although the Federal Reserve, the central bank of the United States, operates independently of the US government, the governments do have some functions within the Federal Reserve. The only functions that the governments have is the ability to elect who is on the board and who is running what positions. So, for example, Donald Trump was able to elect into president the most current Federal Reserve president. And that's an example of how the U.S. government um, has a say, so to speak, on the Federal Reserve and this specific central bank. Other than that, the Federal Reserve has a specific goal and mandate, and their goal and mandate is decided upon based upon their board. So, what is the Federal Reserve? The Federal Reserve is the central bank of the United States. It was created back in 1913. The Federal Reserve has come grown to be one of the most important central banking authorities within the United States of America and around the world. The Federal Reserve Board consists of 12 private regional banks that are located around the United States, and these 12 regional banks get together once every 8 weeks in a club which they call the Federal Open Market Committee to make decisions on monetary policies and interest rates for the United States economy. And the last point here, as I mentioned, although it is part of the government, the Federal Reserve is independent within the government. This gives the Federal Reserve the power to make monetary policy decisions without consent from the president, from Congress, or from Senate. So their goals and responsibilities falls into four main things. I would say this one is the absolute key. Price stability. So price stability, or in other words, to control inflation. Conducting monetary policies by influencing monetary and credit conditions within the economy to pursue maximum employment. So this is another one of their major functions up here. Moderate long-term interest rates by supervising and regulating banking institutions, as well as protecting the credit rights of consumers by maintaining stability of the financial system and conducting systemic risk that may arise in the financial markets. So this is essentially what their purpose is. Here's a map of the Federal Reserve districts. So you can see there's 12 of them, and they're broken down into San Francisco, Minneapolis, Kansas City, Dallas, Atlanta, St. Louis, Chicago, Cleveland, Richmond, Philadelphia, New York, and Boston. So the Federal Open Market Committee, this is the club that makes decision on interest rates every 8 weeks, right? So this club consists of all the participating members of the Board of Governors of the Federal Reserve, the president of the District Bank of the United States, who serves as a chairman by default on the FOMC, and four of the remaining 11 district bank presidents that serve on a rotational basis. Right? That may be a bit of a mouthful for you, but that's just how their system works. They meet 8 times per year to deliberate on interest rates. So the last time they've met, believe it or not, Luke, was yesterday. So yesterday they met and they deliberated on interest rates. And if you're watching markets yesterday, there was a period of volatility at 2 p.m. in the afternoon. That coincides with when they released their decision at 2 p.m. in the afternoon. So ignore this part here, the 4 out of 8 meetings. The reason why I say ignore this is because the new president, Jerome Powell, the new president of Jerome Powell has made every meeting, so all 8 meetings, is followed by a media press conference where the chairman, Jerome Powell, gives a thorough explanation of his monetary policy stance. So this is an example of how um, new Fed presidents are able to change the structure of of the way things were done in the past. In the past, 4 out of every 8 meetings was followed by a media press conference. Nowadays, every meeting is followed by a media press conference. Okay. And the last point here is that these conferences are extremely impactful and will add high volatilities to the markets. So the primary monetary policy tools of the Fed is the Fed funds rate. The Fed funds rate is an interest rate banks charge to each other for overnight loans. This is essentially the cost of borrowing from the highest level, as banks have to borrow. Banks have to borrow money to essentially stay solvent within the system. If they're unable to meet those minimum banking requirements, they need to borrow money. They borrow from another bank at a rate that is stated by the Fed funds rate. That Fed funds rate then trickles down and increases as you spread out to different types of borrowers. So, for example, for creditors, or sorry, for borrowers who are borrowing for mortgages, for borrowers who are borrowing for car loans, school loans, credit card loans, etc., this rate affects everything. All right. Oh, and one last thing I want to mention here is that changes in the Fed funds rate can trigger a chain of events that affects short-term interest rates. It affects foreign exchange, so the FX market is affected by this. Long-term interest rates is affected by this. Money and debt, or in other words, the bond market is affected by this. A range of economic variables, including employment output and prices and goods and services, are all affected by the changes in interest rates within an economy. So you imagine that having the power to make adjustments to rates of borrowing within the economy, and this one adjustment will have a trickle effect that will affect everything from the price of milk to the price of your mortgage to whether or not an employer will be more likely or less likely to hire people within an economy, right? That's how impactful this Fed funds rate is. So here's an example of a chart of the Fed funds rate over an extended period of time. As you can see, there has been a trend here, and that trend is that rates are essentially going towards zero. So they have been falling over the last 30 years, 40 years. Fiscal policy. So fiscal policy is controlled by the government. Fiscal policy is directly impacted by the president and the president's administrations. Fiscal policy has the ability to deal with taxation, so taxation of citizens, taxation of businesses, and at what rate. Fiscal policy also deals with government spending, so government programs on healthcare, on education, on infrastructure are all controlled by the government, and the government has the ability to make adjustments to this. And this can have a huge impact on the equities market. A very good example of this is when Donald Trump came into power, his government issued billions of dollars in infrastructure spending. So construction companies in the United States started getting bought up because all of this free money was essentially going to be given to these companies to help them rebuild the infrastructure of America. Taxation can be reduced or increased, and implementations on tariffs. Right now, these are two of the most key things going on in the Trump administration, and if and it's one of the primary drivers in the S&P 500 and the Dow Jones Industrial Average hitting new highs. Right, is because there has been a reduction in taxes in corporate America. In addition to this, tariffs on imported goods are also being attacked on. So it's forcing American citizens to buy American goods or pay a higher price for foreign goods. Government spending. So um, fiscal policy on government spending will have a huge impact on certain sectors within the economy. Example, more infrastructure spending is typically beneficial for construction companies like Home Depot. So again, if you looked at Home Depot, since the rise of Donald Trump, right, you'll notice that Home Depot shares have been going up quite a bit. Another example of this is military and defense spending will have positive impacts on companies like Boeing and Raytheon, which have typically large government contracts to do businesses. What this basically means is that the government can pick winners and losers based upon how they allocate their budget spending. And as a smart trader or a smart investor, this will create opportunities for you if you know how to position yourselves to trade this properly. And this just comes with some additional knowledge and additional ability to do some basic research and be connected to news feeds and whatnot throughout the day. Market sentiment. So most of the earlier data points release will affect market sentiment. And as I mentioned before, because they are released prior to stock market opening, they will affect other markets. And because all markets are connected, the other markets may be linked to the stock market and more specifically the individual stocks that you trade. And so it's important to look at these other markets for sentiment information on which direction they're trading because more likely than not the stocks will begin to trade in the same direction as well. So understanding sentiment, positive data usually leads to inflationary expectation, causing markets to believe that the Federal Reserve will be more bullish on the economy. This leads to speculation that interest rates will be heading higher in the near future. And as interest rates move higher in the near future, markets will be readjusted to cause readjusted. Sorry, let me repeat that last phrase. Markets will readjust their expectation, um, causing the values of uh, FX, bonds, and equity prices to move based upon that. So the common theme here is that as as interest rates rises, the stock market will begin to fall, right? So going back to this last point here in the chart, take a look at this area here in 2005 to 2007. Let me redraw that. As you guys can see here, this is a period in which interest rates started rising, right? As interest rates started rising higher and higher and higher and getting to this 5% mark here, what began to happen to the US housing market with bad loans? They began to default. And as they began to default aggressively, this caused the collapse in the stock market. And this collapse in the stock market was basically followed by aggressive cutting of interest rates by the Federal Reserve. And they had to slash interest rates in order to help the economy grow. So they did this after a period of raising interest rates. And guess where we're at now? We're at a period now in which rates are starting to go up. So as rates go up higher and higher and higher, eventually we will see a peak in the stock market. So just before I let you guys go, I just want to show you this really quickly on this specific chart. So if we take a look here, this here is a chart of the S&P 500. So this chart here is the S&P 500, and the S&P 500's all-time highs is right here, right? And this all-time high here reflects, or this rally here reflects the Donald Trump government leading it up to here on the S&P 500. The market experienced through this year quite a bit of volatility. But look here where we're at now. We are now trading near this phase in the market, or this particular area in the market. This particular area on the market, or this price level in the S&P 500, now becomes a key contention point, because if the market looks like it wants to retest these highs, no, based upon our understanding of technicals, the market looks like it wants to retest those levels back up there by basically rallying back up, right? If it is unable to break higher here because of the current economic situation, this is when market participants will begin to signal the top of the S&P 500 is coming and that the collapse or the next collapse is about to come. Why is that? Why is that? Is because if we again look back to here, the 2008 2009 recession topped out right around here, right around this particular area here. And because rates were too high, the market started to collapse right away, right? And then you start to see the markets come down. So the same thing is happening now in which interest rates are going up, but because we know that as rates go up to a certain point, eventually that will have a negative pressure on the stock market. Right now, we know that the stock market itself, oops, oops, 1 second, sorry. Right now, we know the stock market itself is heading towards these all-time high levels, but as rates keep going higher, it's going to have a harder time reaching these levels and possibly breaking these levels. So as rates keep going up and this market is unable to hit the highs that it set back in early 2018, this is when markets will begin to speculate that a crash may be coming. Okay? So I just want to leave you with this, and we can go back here and just do our final conclusion. So understanding the difference between micro fundamentals and macro fundamentals is very important. Micro focuses on companies, sectors, industries. Macro focuses on the economy. Learn how these forces will affect the markets and the stocks that you trade. There's a difference between trading and investing, and therefore long-term micro and macro fundamentals will hold true for investors, but we're day traders and we must take advantage of the news that is given to us during the day and understand the forces that affects the buyers and sellers within the markets. All right? Is there any questions for me today, guys?
Oh,
I know this was a handful. There was a lot to cover here on this, and it was less chart reliant and more theoretical. But in the coming classes, we're going to be putting all this information together, and we're going to be applying all of this information with regards to our risk management and trade setups. Which, by the way, I just checked is the next class. We're going to be looking at trade setups and specifically intraday trade setups using news, using the individual candles, using the patterns that we've learned, uh, using the risk management that we're going to be talking about. We're going to be using that to set up trades in the next class. Okay? So if you guys have any questions for me, I'd be more than happy to answer it now. If not, for the next class, if you could do some research and find an example of any stock that was highly affected by news. And it could be news based upon earnings, it could be news based upon scandal, it could be news based upon anything. And show us on a chart how the news impacted the asset that you're looking at. Okay? All right, guys. So if you don't have any questions for me today, I'm going to stop it here. It was a pleasure, as always, chatting with you guys. Again, I'll be in the chat room if you ever need access to me. I'm always here to help you. I encourage you to start trading at least small size now. Trade 50 shares of a particular asset. Just get the feel for it. And as we progress, we're going to be trading together more and more. So, if you don't have any questions for me, I'm going to stop it here. And again, I will send you off an email with the information for accessing the video if you want to watch it again and the module for today's class. So, have a good afternoon, everyone, and look forward to seeing you guys again next week. Bye now.